Hello and welcome. Thank you for attending our event on credit trends and future skills. In terms of introductions, my name is Rob Thakur. I head up the learning solutions here at Fitch Learning, and we're partnering on this event with the GICP, the Global Institute for Credit Professionals. The GICP was set up in partnership with the Fitch Group and very much to develop the skills of the credit community. Those of you working fixed income credit, ensuring that we support that community in terms of the skills that are needed to develop into being credit experts. So this event with the GICP is one of a number of events that we've done. The GICP is fairly new in terms of being just about 1 year old now. It's coming up to its anniversary, and we already have over 3,000 members part of the Institute. And also the GICP has launched the Global Credit Certificate. That is a professional qualification that is aimed specifically for those who work in credit. And we've already had over 80 financial institutions who bring their teams on to having that certification to develop their technical skills and become proficient in the credit world. So this event, we will have 3 esteemed guest speakers for today. We have Richard Hunter, Chief Risk Officer at Fitch Ratings. We have Marina Petroleka, who's the Global Head of Research at Sustainable Fitch. And then we have Joe Locke, who's the Head of Credit Training at Fitch Learning. So the format will be some opening remarks from Richard, Marina, and from Joe. Hi there, come on in. And then we'll move on to a panel discussion. There'll be an opportunity for you to ask questions to the panel as well. So as we go through it, do consider any questions you would like to ask any of the panel as we go through it. But we'll make a start, and we'll start with Richard. So Richard, I'll hand the stage to you.
Main thing, if we look at where the macro position of the credit environment is for us right now, is obviously a lot of it is driven by growth. We see world growth edging down. The US forecast is up, the Eurozone and China are down. US is up. The growth we expect, the expectations that it will rise, but we are a little bit worried about inflation and the impact that that is going to have. That's also going to see a stronger dollar, which has implications elsewhere. And one of the things that, because we've been trying to solve this conundrum of obviously policy rates are coming down, market rates are either flat or going up. What's the story there? And the question is the huge amount of US Treasury bond supply weighing on rates? And obviously that does have the potential to have credit impacts. China, we think the recovery is very much yet to show traction. It, in some cases, has stopped getting worse. I think we've seen a bottoming out of sales, but not of housing starts in the key property market. And the Eurozone is still lagging the globe in terms of growth. And some of that post-pandemic recovery has started to stall. When we look at emerging markets, again, the big story there is exposure to the strong dollar. If you did a chart, we used to do this, of our sovereign ratings for emerging markets against an inverted scale of the dollar, they map pretty much 1-to-1. Just as general credit themes outside growth, really we're seeing 2025 as being the year when events take over from leverage. Last couple of years, leverage has been high, rates have been going up. It's fairly easy to predict where the credit problems are going to come. We now think this year, as we've seen already this week, events are really going to start to take over from that, and market rates are going to be more important than policy rates. This is just a couple of slides in evidence on that Eurozone point here. In both the Eurozone and the US, you've actually seen nominal disposable income in positive territory. But just to make the point, inflation for Europe was way worse. You can see the real growth there, and that has been an Achilles heel. The US is also, there was a buoyed by the fact that at the back end of last year, they revised up how much Americans have saved, and it was to the tune of hundreds of billions of dollars, which again puts more tailwinds behind the US consumer until they hit, I guess, the tariffs. Again, just more information on Germany, just another background there too. Germany really has, although it's recovered from obviously the energy shock with the Ukraine war, those energy intensive industries are starting to see that recovery reversing, and obviously that affects a lot of the people we rate, a lot of manufacturing and industrial names. The tariff story, I obviously had to rip most of this up. These are slides I gave to Rob last week. The story as of Friday night last week would have been, we had made assumptions that the tariffs would go up on all the things that already had duty on them. And about 80 to 90% of the stuff from Mexico and Canada was actually duty-free. Now, what destroyed our forecasts on that point was that he decided to levy tariffs on everything, and that took the effective tariff rate on exports from Mexico, and I've had to write this down, from 2.8% to 25%, and for Canada from 5% to 20% as an effective tariff rate on all their exports. The inbound tariff rate, so all the amount of imports in America that were hit by tariffs, went from 2.3%. We had thought it was going to be 8% if it was just on dutiable stuff. That went up to 13% under the plan as of Friday night. Now, obviously, that plan was changed yesterday, but that does give you a sense of the scale of the change. That was already, our predictions were already going to say maybe slightly less than 0.5% of growth taken off US GDP because of the tariff proposals that we assumed. If they go ahead with the things from last Friday, that would double to about 0.8% of GDP knock. That knock would be much bigger for Mexico and Canada. It would be 2% down for Mexican GDP in 2025 and 1.5% down for Canadian GDP. So last point just to mention, rates are this is the China story. I think everybody is familiar with the importance of the housing sector there. We have started to see sales bottom out and reverse slightly. Starts really haven't made any progress, and they have just exited, but they've just exited from 5 periods of actual deflation. So it's been a very different story to the story we've seen in the West. And the last point, just really about rates, that trajectory is only going to get wider as the ECB continues to cut rates. And the Fed, we were expecting a couple of cuts this year. It was against market consensus. I've just tipped £20 into that charity box for Rob. We had penciled in a couple of policy rate cuts from the Fed during the course of this year. Events of the last week or so are moving us more towards the consensus that it's starting to look less likely that we'll see multiple policy cuts this year. The rates issue is really key for an awful lot of the companies that we rate. With that, I will not slip over too much and hand over to Marina.
Hi, everyone. My name is Marina Petrolek. I'm with Sustainable Fitch. We specialize in ESG ratings, data, assessments, second-party opinions. I'm head of research, so my job and my team's job is not to do the ratings per se, but to sort of horizon scan, take all the wealth of data that we produce through our ratings and kind of tell the story of our data and connect it to big market trends, specifically as they relate to sustainability. So I just wanted to bring you a few observations from the market. I'll connect a little bit to what very helpfully Richard kind of set the whole global macro in a tour de force there. But then I'll give you a few more specifics about sustainable debt and sustainable finance. They're a little bit more nuanced and things that you might or might not be aware of and that might be helpful for our discussion. So this is, and I should say we focus on fixed income. We're part of Fitch Group, so it's fixed income very much the space we operate in. The chart on the left-hand side is total labeled debt issuance per year. That accounts for about 12 to 14% of global fixed income issuance. About 12-40% tends to be on what we call labeled debt. And these are bonds whose uses of proceeds are ring-fenced and allocated to specifically either green projects or projects that have sustainability and or social characteristics to them. So issuers issue these bonds, these label bonds, green bonds, sustainability bonds, social bonds, and another family called sustainability linked, specifically to allocate money towards a specific list of projects. And it's become a little bit prescriptive over the years on what those are. It's about $1 billion. So in 2023, 2024, total issuance was about $1 trillion. And in terms of label, you can see green bonds, you may have heard of them, are the largest component of that market. And then we have social bonds, sustainability bonds, which are a combination of social and green features. And then a couple of other more niche categories like sustainability linked, etc. A chart I don't have here, but is also interesting, is breaking that down not so much by label, but by type of issuer. So the biggest issuers are corporates in this space, can't remember the exact figure, but they tend to be the biggest issuers. Financial institutions are also big issuers, but then governments, so sovereigns, supranationals, agency, public bodies also tend to issue a lot of these bonds because they have missions that drive them to invest very particularly either in climate change mitigation, adaptation, or social projects. And in fact, they're the ones that are really fueling a lot of the market growth, because we've seen in the past year, especially financial institutions have really pulled back from issuing labeled debt. And what we've heard about the uncertain economic outlook, strength of the dollar, that raises a lot of concerns on corporates, I would imagine, and their spending plans. So I would expect next year corporate capex plans to be a lot more conservative, which will, of course, impact to what extent they're issuing special bonds to finance renewables, energy efficiency projects, etc., which is what goes into this family. Now, what's interesting about the sustainable finance market and the label bonds market is that it's a principles-based market, right? It all operates based on these 4 principles issued by the ICMA. And adherence to these principles is voluntary. So if you're an issuer, if you're a corporate issuer and you want to bring a green bond to the market, you don't have to adhere by the principles that govern or that are suggested by the ICMA, International Capital Markets Association, under their green bond principles frameworks. However, it's become expected. 97% of the issuance of labeled debt aligned to the ICMA bond principles. And here we have green bonds, sustainability, social, and sustainability-linked bonds. Second-party opinions, which is an independent opinion provided by an external provider such as Sustainable Fitch, are opining effectively on the alignment of the green bond framework, of the bond framework, right? Because if you want to issue one of these bonds, you have to tell the market what you're intending to do with the proceeds, how you intend to report. There's some legwork that goes into it compared to a vanilla bond, let's say. So we would opine on the alignment with these principles. And then just a few weeks ago, the EU issued a new bond standard that will sit kind of alongside these. It's called the EU Green Bond Standard, also a voluntary standard. But if an issuer chooses to align with that standard and follow its due process, there are mandatory elements to it. So you can't pick and choose. If you choose to launch an EU green bond, you have to do certain things. And then these are the components. So if you issue a green bond, you have to you have to tell investors what you're going to do, what you're going to use the proceeds with, the process for evaluation and selection, management of proceeds, and reporting. Now, why do I say this? Because the other key component in this market is the ESG ratings element of it. And this is where Sustainable Fitch kind of lives, right? We're a provider of ESG ratings, second-party opinions, assessments, etc. So why do ratings matter? Why do ratings matter in a market that's largely based on principles, voluntary frameworks, etc.? One thing we hear a lot is that you have credit ratings, and this is an interesting chart. It's been around for 5 years or so, this chart. As long as I've been doing this, I know about this chart. And they show, well, you have your issuer credit rating, and they tend to converge more. You won't get massive distortions in the credit rating of a corporate or a sovereign between the main credit ratings agency, of course, Fitch being one. However, they ran, whoever it was that did this chart, they took the ESG ratings from various providers. It says Fitch, but we're not listed here because it was before our time. But anyway, and you can see there's so much divergence, which kind of led to the question of, why isn't there more convergence in ESG ratings? Well, I think one thing for you to understand is what are ESG ratings trying to do and what data they're based on. On the one hand, obviously, credit ratings align. There's very standardized data that underpin credit analysis. IFRS, general accounting principles, they provide incredibly standardized financial information and balance sheets. And, all of that is widely accepted around the world. That's not so when it comes to sustainability and ESG metrics, right? They're standardizing slowly now. There are a couple of big institutes. The IFRS is one that's trying to create the equivalent of a financial statement on the sustainability front, sustainability statement, and try and standardize it. But you don't have a standardized set of data, number one. So number two is ESG ratings actually rate different things. What we do in Sustainable Fitch is we rate the impact an issuer and its bond or its instruments have on the environment, the society and how good their governance is. We have and we call that an ESG ratings because that's what it is. We have competitors in the market who rate the financial materiality of a company. So to what extent will a company be impacted by physical risk, transition risk, environmental risk, social risks, etc. So they measure, you might say they're two sides of the same coin, but they use different data, or they might use similar data to measure and output different things and provide a different opinion. So the reason they matter, the ESG ratings, is because you don't have a standardized base of data. Everyone's sort of providing their own opinions, but what they need to do is provide decision useful information to investors, especially as elements of sustainability, especially on the environmental front, become more material for investors. Okay, and that's why they matter. But for them to be good, they need to be transparent, they need to be clear, and raters need to be held accountable. And that's why there's now regulation coming in for ESG ratings agencies such as ourselves and our competitors or our peers, that we need to provide transparency. You need to tell investors what it is that you rate. Because up until recently, and I'm thankful to say Sustainable Fitch was not one, we've always been very transparent, but it was sometimes difficult to understand what the ESG rating was trying to tell you. What was it rating? Was it rating the risk to the company from environmental risk? Or was it rating how green the company is and their footprint on the world? Okay, so that's an important distinction. So clarity, accountability, transparency are important. And there I've just put a sort of a chart from some of our ratings on green bonds, where we rate a lot of them that are aligned to a regulation called the EU taxonomy. We rate them as excellent because from an environmental perspective, they have the most robust science-based criteria behind them, some of the bonds that we rate in there. So that just gives you a sense of what a rating looks like.
Hi everyone. So I'm just going to go through some skills that are quite useful in the world of credit and have been quite useful in my career in credit. So I head up our credit and risk training here at Fitch Learning, and this is my 4th year with the organisation. But before that, I had a 20-year banking career in credit. So I started as a credit analyst a long time ago and worked my way up, credit portfolio manager, and managing various different portfolios. I worked through the financial crisis, through the European sovereign debt crisis. I was my bank's UK sovereign risk analyst for Brexit and through the pandemic. So lots of sort of real world experience, which we like our trainers at Fitch Learning to bring into the classroom when we're teaching. But we're going to talk about skills today and what skills do we have or can we learn in credit. So I've just put this together, sort of a nice little road map, if you like. We start with our analytical and quantitative skills. Credit is a numbers field. You have an analytical brain, you have a natural sort of inquisitive mind, you're dealing with financial data, annual reports, rating reports, market data, sustainable data, like Richard and Marina have already showed us a lot in their sort of 5-minute slots each. And we have to process that and we have to boil that down into credit recommendations and decisions and approvals and strategies, and we have to adapt those as things in the world change, and we know things in the world can change very, very quickly. That kind of ties in with the second one, so technological proficiency and data literacy, but probably with a bit more emphasis on this one now with what is happening in the world in terms of data, AI, transformation, the big data that we are confronted with. How do we boil down all of these data points to a credible credit strategy in our day-to-day work for the portfolios of companies or institutions or assets that we manage? I think another one that's really helpful is product knowledge, knowing about the credit products that are out there in the market, understanding, the different types of loans or bonds or trading credit, financial credit lines that you might have if you work for a bank, for example. That kind of leads us on to our regulatory knowledge. The banking industry is very heavily regulated, but there are all sorts of regulations out there in the world that if you are an entity operating in a country, you have certain regulatory requirements. So as credit people, we need to keep on top of those developments. What is changing? How might that impact the credit profile of companies or issuers in our portfolio over time? And then I've got a sustainability awareness skill, which ties in with Marina's presentation just before. The world is changing. We have sustainability objectives. Our governments have pledged to reach net zero by hopefully 2050, but some of the governments different dates, and making sure that the businesses are aligned with that actually can bring material risks to their credit profile. So how do we understand what's happening in terms of sustainability and how that might impact the world of credit? And then we're on to sort of softer skills now. So communication skills and problem solving skills. Get my teeth in. So credit is based on data. You've got to analyze the numbers, but then you need to tell the story. And often a credit function in a company or in a bank will be connected with so many other functions in that organization that you have to be able to communicate your views, your points, your data, your strategies effectively. So the communication skills is one, and problem solving skills as well. When we have a crisis in the markets, things tend to move very, very quickly. We have to, be on top of what's going on. We need to understand how are we going to solve the problems that come in from our portfolios of different credit takers in a speedy way. If you think about Credit Suisse and UBS, their sort of merger that came in March 2023, that was engineered over a weekend. You don't have a lot of time when something is going wrong, and you have to have those skills to be able to deal with that. And then finally, I've got adaptability and continuous learning. The world is evolving. We need to evolve with that. We need to be adaptable. We need to adapt to data developments. We need to adapt to what's going on in the world of sustainability. And we need to keep learning because things are always going to change. I'll leave it there.
Brilliant. That's great. Thank you, Joe. Are there any questions you'd like to ask either Richard or Marina or Joe at this stage in terms of what they covered there as a high-level overview?
Just a quick question on returns of sustainable bonds.
Yeah, so as I said, it's about $1 trillion a year that's issued. So it is a large piece of the market. The most as far as we can tell, and we in my function, we don't look at the secondary market so much. But as far as we can tell, the primary market is incredibly active. Sustainable debt doesn't trade as actively in the secondary market, as far as we can tell. And in that sense, it's slightly different to some of the other big fixed income categories, whether you're looking at sovereign debt or indeed corporate debt. Investors tend to buy and hold quite a lot of it. So as far as I know, and again, it's not a market we look at very deeply, the secondary, it's not as active. So that might actually be one of the reasons why I don't have readily available data on their returns.
But in terms of what you covered there, it'd be good to expand a bit on those points. And Rich, I'll start with you as Chief Risk Officer at Fitch Ratings. I think you know a little bit about ratings, credit ratings. What are they telling us about the market? What are the credit ratings indicating about the market currently?
Well, if we look at where the rating actions have been the last year, there's two real things. There's where have the upgrades and downgrades been, and where are the outlooks? Because we assign outlooks to all the ratings to say where do we think the likely direction of travel is. If you look at the trend over the last, in this case it's calendar 2024, we actually had more upgrades and downgrades by quite some margin. So it would be something like 10% plays 2% upgrades versus downgrades in all the asset classes except two. They're kind of obvious ones. You would guess that CMBS, commercial real estate, had a net negative balance of about 8%. And actually in corporates, it was very, very finely balanced. And that gets into where we are in the leveraging cycle. And so I think the ratings last year did pick up that there was this balance that was slightly shifting, and that's where the outlooks are going to tell us something slightly different from that positive sounding story. But the corporate leverage cycle, there's really two corporate cycles. One is the earnings cycle they have. The other is when do they feel like leveraging up. And last year was one of those very short, shallow troughs you get in the leveraging cycle these days, where a lot of corporates have decided to lay off the leverage switch for a while. We are seeing them moving back towards the leverage switch now. So we do expect more downgrades, and certainly a lot more M&A and LBO-driven downgrades in the course of 2025. Across the rest of the portfolio, most of the outlook balances are actually more or less neutral. So that would suggest fewer net upgrades than we saw last year, again, with the exception of commercial real estate, where that's a net negative balance. Corporates, again, also just about neutral going forward. So that's what the ratings are telling us, certainly at the moment.
Okay, brilliant. Thank you, Richard. Marina, I'll turn to you. You took us through the labelled bond market, a re-pickup, we saw that, an uptick on that side, which is great to see. What are you seeing as the market drivers for the pickup on the market in terms of label bond issuance?
Yes, and I alluded to that a little bit, but it's good to expand. As I said, the big area of growth last year came from what we call SSA, sovereign supranationals and agencies, so public bodies issuing a lot of debt to the market. More broadly, the reason, if that's kind of the crux of your question, why would an issuer decide to have a green bond or a social bond or a sustainability bond? A lot of it has to be driven by the fact that it tends to be driven by the fact that they want to allocate capital to a very specific set of projects. And there is a mechanism in the market to also signal that. So some of that has to do with kind of telling investors and telling the market, specific areas that they're investing in as it pertains to sustainable kind of outlets. At the same time, it's not just issuers placing that. It's because investors have become quite, they want more of that type of debt, right? It's a symbiotic relationship. If they were placing it and no one was buying it, obviously the market wouldn't have grown to about $1 trillion a year. The other reason, and again, this is a question we get a lot, is to what extent is there a pricing advantage to, they used to call it the greenium, to a green bond compared to a vanilla bond. So you have an issuer issuing two bonds. One is a normal corporate bond, vanilla as you would call it, and the other one's a green bond. In the early days of the market, when there was a disconnect between the supply and the demand, because there was higher demand by investors for these types of bonds than there was supply, there was indeed a pricing benefit for the issuer. So they would get a slightly more beneficial interest rate on that bond. So they paid less to issue a green bond because there was just so much more demand compared to a vanilla bond. However, there have been some studies, the most notable one from ESMA, which is the European Markets, Securities and Markets Authority, saying that they don't see that in the market anymore, which means it's not a structural feature of the sustainable debt market, but it was more of a feature of an imbalanced supply and demand, which has now normalized as the supply met demand, as it were. So it can't be pricing, or it would be odd if it was still a driver for a lot of the issuers, considering that they would get a lower interest rate, because it doesn't seem to be playing out in that way anymore.
Okay, and if we move to the buy side and look at it from the investor's perspective, what's driving the demand there? If it's not this premium or greenium, as you put it, what is driving the demand there?
Right. So why do investors want to invest in these bonds? And it goes back to the question that the lady asked. I'm sure they will argue that their bond portfolio obviously is outperforming everything else. I'm sure every investment manager will try and argue that. The investors that we speak to, and the investors that tend to sort of need our data, our services, they're what you would call impact investors, right? So they have a mandate to invest in securities and fixed income, in our case, but also equities, which is a much bigger part of the market. They have a mandate to invest to get risk-adjusted returns with positive outcomes, either environmental and/or social outcomes. However, they're not philanthropic institutions, and it all boils down to credit risk, ultimately. And it kind of goes back to what Richard's been talking about, and obviously what Joe teaches. You won't find an investor in the market that will buy a green bond for the sake of it. They will buy a green bond from an issuer because their thesis is that a company that has better sustainability credentials or is investing in sort of enhancing sustainability, let's call it infrastructure, has better resilience long term, and therefore the credit risk over a longer horizon is lower. It's sort of, if you speak to enough investors, it sort of tends to boil down to that, right, for a lot of them. And that's why they say risk-adjusted return. Sometimes they might underperform, but ultimately they feel they're investing in what will be a more resilient, good business means more resilience long term. And that's why they tend to, that's sort of the core thesis there. It's not philanthropy. They're not investing because they're pure of heart. Because sometimes you hear that, in corners of the market, and that's not what's driving a lot of these investment theses, as far as we can tell.
So you've got true market dynamics then impacting
course,
the demand
of course,
side as well as the
of
supply.
course.
Brilliant. Great. Thank you, Marina. Joe, I'll turn to you in terms of skills training. We can't have a discussion without mentioning two letters, AI. That's impacting everyone's roles. Is there even a reason to have an analyst anymore? Can't we just get AI to that? It's all right, Richard. Don't worry. Hopefully there still is. And if there is, then what is it? How is the role of the analyst changing now we've got AI coming?
Gosh, if I go back to the start of my career, when Fitch Ratings rating reports on issuers came in a big thick book that sat on the desk, and then we progressed to CD-ROM, and now you can log into the portal and download. Life changes. We have technological development all the time. We've just stepped up the pace. The AI tools that we have at our disposal now can really make our lives easier. I spent so many weeks, months, years in the early stages of my career calculating ratios, spreading financial accounts. We can do that now automatically. But what the tools can't do, or maybe we can't trust them to do it yet, is interpret that data and to make a judgment on that data. So it's all very well, I can have a nice printed sheet of credit-related ratios. What do they actually mean? How did we get there in the first place? So what sits behind the ratio? And what are the trends? And do I believe that those trends are actually going to continue into the future? So in our rating models, on the rating side, if I think about the sovereign rating model, for example, we have a model that gives our sovereign rating, which has various different weightings. And then we have a qualitative overlay, which is kind of like the human adjustment. And I think you really need that. I don't think you can just take what the system or the model or the AI tools is telling you. You need to sense check. Anyone who's used GPT, you need to sense check, yeah? And these tools can be useful to assist us in our work, but I don't think they can do our work for us yet. Yeah. Then we can have another discussion about, in 20 years' time, will we still need analysts then? I would personally say yes.
I think the big challenge is going to be between now and 20 years' time, say 5 years' time. If you said, and this is something we're tussling with as an organization, if you said, I'm going to ask Mr. AI to pull together all the data, do all the adjustments, the ratios, pull everything together in a pack, do an automated summary of developments for the issue during the year. It can set up a rudimentary forecast, the analyst can tweak. So all of that stuff arrives on the analyst's desk, and you say, we still want 5 humans to look at this. How do you train the 5 humans to have the same gut reaction? Maybe 5 years out, 7 years out, 8 years out. It's fine to say leave the human driving, but the real challenge, I think, and it becomes almost a training challenge, is it's a bit like the driverless car. Once the car is doing 95% of the driving, I'll probably be okay taking over from the car. My son's probably going to be okay. What are his kids going to do if they're suddenly confronted by the car, throwing back control to them if they've never really actually driven without assistance? And retaining that kind of, so how you have the judgment of the human with all the AI support, I think that's, very often when we look at that internally, we talk about that as kind of like, it's a training exercise. You've got them to look at the global financial crisis. You've got to get them the case studies on the Eurozone crisis and the pandemic. Those are things we kind of do as nice to haves now. That's kind of interesting alongside the basic training. They might become the basic training.
So we're not going towards driverless ratings then. We'll still have someone driving that rating.
Not immediately, no.
Okay. All right. Thank you. Thank you, Joe. Thank you, Richard. And we can't have a credit discussion without talking about private credit. We know the growth there, forecasting $4 trillion in the next 3 to 5 years. Richard, I'll start with you. What's your view on private credit, where that's going?
So yeah, it's good to pick up on the growth, and it also links in with what Joe was saying about continuous learning as well, because our standing position would be, is it a systemic risk? We would say, no, it's not a systemic risk any more than anything else. More than $1 trillion has the potential to be a systemic risk. Leverage loans are over $1 trillion. Lots of things are over $1 trillion. The issue we think when we look at it is, if I had to pick one thing, it is the fast growth. and it is that there's it's kind of like the supply and demand. We've already seen over the course of the last 20 years what happens when people chase yield. It doesn't always end up in the most constructive of areas, whether that's public market or private market. Private market is kind of just a new term for alternative asset managers anyway. There's been a lot of direct lending going on for many years. A lot of the asset classes they invest in that are liquid have just been invested in by alts. We're now calling it private markets because it sounds slightly sexier. From our perspective, there are two particular things that I key in on. One is the public market has lots of roles it fulfills. One of them is it creates a kind of a clearing price for standards. And, so it's not just rating agencies that set the standard for what should be in an ABS transaction or what sort of covenants are, going to stack together to work for a decent credit rating. The public market does as well. And when you get private market instruments, they can very often look at, the recipe book and say, well, if I'm originating this and I'm selling it to my own insurance company, I don't need hedging on that. And it comes to the rating and you say, well, yeah, but it's supposed to have hedging for that. It's like, well, the public market wouldn't accept it. You couldn't sell it without hedging normally. But here we have an instrument that might say, well, we're just not going to put the hedging. What does that do in credit terms? So then that throws us back into the discussion of, well, what was the purpose of the hedging in the first place? And is it a comparable rating to that if it doesn't have hedging compared to an instrument that does? Usually the answer is no. And then you also get onto probably the final argument around this, which is, again, these closed ecosystems that can come up with private credit, which is not the case for all of them. There's a lot of secondary trading inside private credit. But when it is a closed ecosystem, is the only external validation a rating agency? And then you get into the question of which rating agency do you choose? And any area where the over-reliance on ratings as a regulatory thing exists, as a rating agency, perversely, we would say is not a healthy thing, right? It should always be one in a broad mix of things that people look at. And the fewer items you look at, whether it's us or something else, the fewer validation points you have, the more challenging it becomes for the individual analyst who's making that credit decision.
Do you see that as a concern? You see that as a big risk?
Oh, yeah, absolutely, yeah. Yeah, I mean, the public market, like anything else, the disclosure requirements, which are the big thing that people tend to pick up on, an awful lot of direct lending that you look at, if you look at the direct lending package that the companies put together themselves, they're very detailed, they're very thorough. They're not scant in some way, they're not missing anything. It can be a little bit difficult to get hold of the company when they get into trouble, but to be frank, with all the companies I've seen get into trouble over the years, even though they're publicly listed, they haven't always picked up the phone as the first thing when we've tried to call them. So companies generally go a little bit dark when things get tough. So yeah, I think the limiting number of validation points and the way that the public market itself sets a clearing price on a lot of those, almost without realizing it. Yeah, I think that is it's a definite concern in the process. Yeah.
Sure. Okay. We'll stick with private credit. And Marina, from a sustainable debt perspective, what are you seeing in the sustainable finance space?
So I think that's where we're going to get into the slightly more pedantic definitions, because so everything that I've shown you in our ratings, one of our main products, is for what you would call the public markets. And typically they tend to be investment grade, a lot of the issuers in this space. Not always, but but it's definitely in the public market. On the pure private credit side, so direct lending, we've seen some of the big asset managers like Ares, Apollo, they kind of dabble into the idea of putting some ESG covenants on the bonds, on the loans or the transactions they make, but a lot of the time you don't really get that visibility. But we've heard that they're trying to do some of it, but I don't think it's such a big growth area. Where we are operating and we're providing an opinion is on the leveraged finance market, which I would say is adjacent to private credit. You wouldn't call it part of the private credit tent, but it's adjacent because it deals with big, medium to large size private enterprises and their debt that has typically been arranged by a bank, and it's kind of traded in CLOs in the leveraged finance space. And we have developed a product where we score each of those companies, so nearly 2,000 companies in total that are whose debt live in these kind of CLO wrappers and packages. We rate it, or we provide a score on their environmental, social, and governance credentials. The reason we do that is because there are some very, very big investors, asset owners in particular, pension funds, especially from Japan, who are very big investors in CLOs, sovereign wealth funds, that are demanding now from the investors, from the CLO managers themselves, a view on the environmental or social or governance credentials of these private companies that they are buying the leverage loans of. I apologize if I'm mixing up my terms, but
Hang on.
it's a market has taken me a little while to kind of unpack. That's not private credit. It's not direct lending between, you know, one or two lenders and the corporate, but it is adjacent because you're dealing with private companies that do not actually, for our purposes, disclose sustainability information. So we've come up with a methodology where we can look at the business line they're in and kind of triangulate with the EU taxonomy and other kind of sustainability criteria and give investors an opinion, an independent, hopefully informed opinion on some of the ESG credentials of those. Again, I think it goes back to the asset owner, the big, you know, pots of money that are controlled by these pension funds around the world. They want to get a view, not to understand so much the impact, but I think ultimately to understand the credit risk that I'm getting exposed to. Am I investing in a CLO that's full of companies that are, you know, investing in very environmentally unsustainable business practices? Not because of a conviction necessarily, but because what does that tell you about transition risk, potentially? That's sort of I think again, the investment thesis, it boils down to, but that's how we get involved. We look at private companies and we're trying to make an assessment, disclosure agnostic assessment on their environmental, social, and governance profiles, if you like.
Great, thank you, Marina. Right, we're going to open it out for questions that you have for us. Before we do, I'm going to ask you all the same question. It's, you know, we're partnering with the GICP here. We're looking at skills development. What advice would you give the audience here in terms of looking at future skills that you need if you're working in a credit-related role? What advice would you give them? Joe, I'll start with you.
Okay, gosh. Well, as you've seen from today, there's a lot going on in the world, and all of that in some way, shape, or form impacts credit. So keep abreast of what's going on in the world, in the market. Stay informed. That would be one. 2, be curious, be nosy, take an interest in what's happening and what might happen next, and what does that mean for the business that you're managing or analysing or dealing with. So I think that would be my second one. Gosh, let me think of a third. Maybe you can come back to me.
I'll come back to you for a third one. Richard?
Yeah, I'm trying to think of one. Linked back to AI, maybe a slightly forward-looking one. And it goes back to private credit as well. One of the challenges that we have right now when new products come to us is the team has to develop criteria. That criteria has to then get reviewed. There's a model validation team that works under me that sits and reviews them all. And one of the big challenges they have is working out what does the documentation tell us is supposed to happen in this transaction. And again, the more you move away from like plain vanilla or photocopied market standard transactions to something where something might be slightly different, you know, it's not nowadays going to be something as obvious as they have a slightly different event of default hidden away in there, or something nasty in the negative pledge. And our model validation team have actually worked on a project that uses AI to help them spot where non-standard, or not even non-standard, but just where the flow chart they have to build a model to understand this departs from what the existing model would show. So I would say, if I was going to give, it's something maybe hugely ambitious for a lot of people, but to work with people who can use AI to do that, to say, as an extra pair of eyes in the documentation gets ever more complex, and use it to spot the holes that the humans won't, that the lawyers have put in there.
Great. Thank you, Richard. Marina, maybe from a ESG sustainability perspective, what advice would you give in terms of developing skills for the future?
I think if someone is to be in the sustainable finance market, I think first of all, understanding the principles, how this market operates. For me, it was tremendously helpful to spend some time, not a long time, but some time in Richard's organization. I was in credit policy for about 1.5 years before I moved on to Sustainable Fitch. And really understanding credit risk and transmission mechanisms of that risk. I also found it to be incredibly helpful in my thinking and understanding this part of the market, because we don't do credit necessarily in our day-to-day, but having that grounding and that understanding helps you differentiate a little bit on the market developments, what's driving it, why are issuers issuing, why are investors investing. It's a helpful skill to have that context.
Great, thank you. Jo, did you think of that?
I did, and I had it in the back of my mind from before, and it's just something that I think actually you've all kind of automatically just helped me say thank you, is about joining the dots. So you have the foundational knowledge, and Marina and I were talking about this before. Where do you get that knowledge from? We both, in our course of our careers, picked it up from various different places. It's taken us quite a long time to learn that. So have that foundational knowledge and be able to join the dots between what does that mean, what's going on in the market, with the AI piece as well, with the sustainability piece as well. And we see that on our training courses. People come on our training courses and they've got blocks of knowledge, but they haven't quite joined them all up. And this one helps you understand that one and helps you understand that one, which has consequences for the first one. So it's just all about joining the dots, really, because these are things that are all linked together.
Very good advice. Great. I'm hoping there's questions here. Who wants to start? Let's go question for the panel. Oh, great. Thank you.
Thank you. Question for Marina. Yeah. Do you expect perhaps a slowdown on sustainability issuance, both from investors and issuers, given that now the richest country in the world seem to be less interested in this kind of space? Yeah.
Yes, but not for that reason, if I may. What's interesting about the labeled debt space, and it might have been helpful if I showed you the data by geography, the largest issuer of sustainable debt, ESG debt, labeled debt, it all means the same thing, is Europe. That's where it started. That's where the market really started. The second largest region is Asia Pacific. The third largest region, by a mile behind, is the United States. It just never really took off as a piece of the market. Now, the US has the deepest, biggest capital market in the world, and yet sustainable debt from the US has just remained sluggish. And in fact, it grew under Trump 1.0, fell under Biden, and most certainly will keep falling under Trump 2.0. So it's not a correlation necessarily, a direct correlation with policy. What I'm looking at, and we don't forecast in my team, we try to avoid forecasting precise numbers for sustainable debt. We look at elements of the market, whether there's upside risk or downside risk. Financial institutions and to what extent they're going to issue next year, especially Chinese, because they were very big issuers of green debt. Chinese financial institutions really stepped away from the market last year. A bit of a question mark whether they will come back and why would they. So that's a big chunk that might be missing or might be adding to the market. And the second big piece, which I said also in my remarks, is corporates and capex, and that's where policy might matter, because it might make corporates a little bit more circumspect when it comes to their capex plans, and that will extend to their capex related to low carbon or other energy, energy efficiency programs, etc. It's kind of a catch-all, I think. So I think there might be a little bit of weakness from corporates, which might, taper the market a little bit. And then finally, the EU, which is a very, very big issuer of green debt, under their Next Gen EU program, which launched during COVID, and it was a big stimulus to the economy. That's supposed to run out next year. So naturally, we're expecting that to taper. They might extend it. They haven't used all the funds, but that's going to be a big slice that leaves the market as well. So what makes up for it?
Thank you.
Just on that note of the richest country in the world, if, for example, you had to change your slides, Richard, based on news that just came out in a day and the rapidity of the change that's going on, these major changes, I'm just wondering how that's going to affect, say, corporate planning, ratings going forward, and things like that, to how that these sudden changes.
Couple of things. Ratings are actually quite slow-moving beasts. Remember, we have 20 notches to get everything from Federal Republic of Germany to a just about to default Brazilian steelmaker. So they're quite, they're not particularly granular, and they are quite slow moving. I did actually, the internal message this year to the analysts was very much to say, but this year you're going to be measured on how you react to events as opposed to whether you anticipate them, because the audiences that we have don't realistically expect us to be able to anticipate everything that's going to happen in the last 96 hours has been a fairly good example of that. I think the point that Marina made is absolutely key. One of the discussions we're having, whatever the eventual outcome around the tariff discussion is, and this is a point I constantly make around different topics, is anticipating the anticipation. So we had the same thing with the Eurozone crisis where we said, well, these countries won't leave the Eurozone. It's like, yeah, but suppose they think there's a possibility they might, they're not going to wait until it happens until they do. And if you think there's going to be a problem with expanding your factory in Ontario or in Monterey, and you don't have to have actual evidence that it definitely will, you're just going to not do it. And in an environment where lots of policy issues are in play, that is just going to depress capex generally. So it's something that our analysts who look at the obviously the manufacturing sectors, capital goods sectors in particular, are looking at just now. In fairness, those teams have a reputation for generally being quite conservative with the numbers they expect for investment. But if there was one data point, I would say we probably have wrangled with more internally between the economics teams and the corporate teams, it's capital investment, where the corporate analysts tend to lowball it, and the economists say at the high level say, well, the investment comes from somewhere. And I feel like this is one of those areas where you're going to see the economist numbers gravitate more towards what the corporate teams are saying.
Great, thank you for the question. We are there on time, so there will be an opportunity, I'm sure, to ask our esteemed colleagues questions over lunch, but can we show our appreciation for Richard, Marina and Joseph? Thank you. Great, just to wrap up proceedings, some events to look forward to. So on the left-hand side, the next virtual event is on the Mystifying Corporate Sustainability Reports. So that's through the GICP. It's free to be a member of the GICP, and you get access to these events and webinars and reports as well. And on the right-hand side, if you want to know more about the Global Credit Certificate, if that's something that you think will help develop your career within credit, then there's a webinar specifically to find out more about the GCC. Thank you very much for your attendance. Hope you found that useful, and please do stay for lunch. Thank you very much.